about, I guess it's 1104, where if a brokerage firm owns any part, be it 1%, 2%, 10%, is that correct? Then they would have to be limited to 15% compensation, cash compensation? Not them, but I mean the total cost of the offering for the company.
Michael, can you repeat your question?
Can't hear in the back.
Andy's question, tell me if I'm paraphrasing it correctly.
Yeah,
you want to know if there's any ownership, regardless of how small, by the broker-dealer into the issuer, be it only 1% or fragment, that limits the cost of the offering to 15%, including compensation.
Right, and that is true. The rest of that question is that it is true. What about payment to the attorneys, to the accountants, to the printers, for the road show?
And if that's true, what about all the other costs, attorneys, road shows, accounting, etc.? And you're directing that to? Joe Price.
Yes, well, thanks for that question. The rule is going to apply regardless of whether there's any affiliation other than between the broker and the issuer. So it's the percentage threshold just would trigger whether you have to disclose that you're an affiliate of the issuer and the nature of that affiliation. But the proposal is to apply to all private placements in which your broker participates.
So then again, expand that to what about the cost for the attorneys, the accountants, et cetera, et cetera, et cetera?
Yeah, right. Well, I want to see how the comment letters come in to parse that. But certainly initially we consider that the attorney's fees would be within the 85%. That would be, costs that are necessary to generate the return on investment as opposed to, commissions and fees. That's what we have going in. But if there's a way, and I think we need to, because we've gotten this question several times, we need to be clear about those kind of fees and how they're treated. But follow up, there is no cap on the 15%. There's only a cap on the 85%.
You're speaking to the broker-dealer's attorney's fees, not the fees going to issuers. If part of it, if most of the proceeds to issuers counsel is coming out of what's going to the issuer, that would be okay.
Clearly, yes.
With the accounting expenses, some of the appraisal expenses and things to do with papering a deal.
You're going to use a mic. Use a microphone. Nobody in the back can hear.
Joe and I had unfairly, to the audience, talked about this subject a month ago. So I was just starting to bring up something we had talked about. We had talked about at our last conference of NIBA in Las Vegas, as those of you who were there, about boxing NIBA's official position, which we haven't even sent to Joe yet, but we will be sending. We want to be kind of one of the last ones that you got. But is to box the line item expenses of what we would call papering a deal. One of the reasons that our broker-dealers are interested in boxing the line item costs of papering a deal, as I had explained to Joe, is because the majority of issuers that are in this room and have come to NIBA for 35 years are putting deals forward that are $10 million or less. In many cases, $5 million or less. And in some cases, $2 and $3 million on small private placements. So when we look at the cost today of conducting outside and internal due diligence, both an outside report by a Backwright, Buttonwood, et cetera, Nick Associates, Paul Materco, whoever. And then the inside due diligence cost that the broker-dealer has, and then appraisal and valuation costs in a lot of deals, especially deals that are equipment-oriented. We have appraisal costs. And we put those all together with the accountant's costs, the review of the audit accountant's costs, the papering of that side, exclusive of internal costs the broker-dealer has, are substantive. They can easily run $150,000, $200,000, $250,000 to paper, just to paper the deal. And obviously, if we're doing a $5 million deal, those papering costs, the 250, is 5 points of the, quote, 15 points, which leaves only 10 points to sell the deal and pay the commissions to the broker who's selling it and give the brokerage firm a little profit, which is obviously a squeeze. So, Andy, is that part of your...
Yeah, that's exactly what I was talking
I would like to respond to this question.
So therefore, how we allocate the attorney's fees and the 85% part, our appraisals, valuations, things like that. In other words, how we allocate those line items becomes critical. Because if we boxed out all those expenses, say a deal was $150,000 to paper, it's fine if we could leave that $150,000 in dollars instead of in percentages, and say those 30 line items are what we allow, FINRA, SEC, or whatever you want to call it, that's what we allow. Everything else over that can be a commission, and maybe now we don't need 15 points. Maybe we only need 11 or 12 to keep it so it's not 25 like your other commenters said.
Well, Doug, Doug, you wanted to say something?
Yeah, well, it's kind of along the same lines. It's one of the issues that we run across.
Do you want to stand up so the other people can hear?
Sure, okay. Kind of along the same lines, one of the issues that we run across is the FINRA has a table of what we're allowed to charge depending on the size of the deal, public offering, et cetera, et cetera, et cetera. And they take points away for right of first refusal. That's considered compensation. They take points away for warrants. If you happen to get equity in a transaction, for doing other for actually helping the company out before when they were not ready for financing, and we put a lot of work into that. And for that, the company doesn't have cash, because obviously you have to raise capital for them, but they're willing to pay us in equity. There's an integration issue automatically. So there's a lot of things that banking firms do besides just go and get a company that's cookie cutter ready to go raise capital for. Not all of them are, especially in the smaller raises.
None of them are.
Exactly. I mean, we're not dealing with typically a company that has a huge auditor and a huge law firm that has kept them in line. There's things that we have to address through due diligence, and especially I do a lot some emerging markets, and to do a background check in China could be up to $25,000 per person. And it becomes prohibitive as well to do the proper due diligence that we are going to be now, that we've always wanted to do and have done, but now, it's going to be a bigger burden on us, and a bigger liability. Well, the crosshairs are going to be squarely on anybody that's involved in the due diligence process, based on the way I read the amendment.
Great, well, this is...
My name's Jim Hawk.
Jim. Where's my pen?
What are you laughing about?
Should we get the question in the back before I start to answer?
Do that. We'll get you just 1 second.
Right. I completely agree with you. Those provisions that are part of the corporate financing rules, the values for right of first refusals or warrants and securities aren't part of this proposal. Are we going to come up with something where we apply some kind of arbitrary percentage thresholds that keep a small business that needs money and finds a broker who can raise it from that happening? God forbid. That's not what we want to do, unless the investors really don't have any reasonable way, it's being sold to people, the investors don't have any reasonable way to get a return on their investment. So the 85% was just, our initial proposal to try to capture that concept. But we're going to listen to what everyone has to say about smaller deals, about, expenses that are incurred, and certainly take that, when we send the rule out to the SEC, it will be a lot more granular, and it'll benefit from, the feedback we're getting on this.
And I understand for the rule regarding private places, but how about public offerings? Are those rules going to be revisited now that you're dealing with private placements, and maybe take some of those same issues with the public offerings? The public offerings are more expensive actually, and eliminate some of those arbitrary points that are allocated towards some of those the first right refusal.
The question is, are they going to do it for public offerings?
Well, the last major amendments we did for the public offering rule took effect in 2004. So it certainly is time to look at that again. As I say, we're kind of doing one-off projects with regard to rights of first refusal in terminated offerings that go to some of the issues we're seeing and not rolling that into a kind of a comprehensive rewrite of the rule. Right now, I'm really focused as well on unlisted valuations, customer account valuations, and unlisted DPPs and REITs. So I think that's probably going to be the next big project we're going to undertake. And I know on the advertising side, I published this notice 1006 about using social media to conduct business, and we're having a task force meeting next week. We're going to give more guidance on broker dealers' websites and hyperlinks and those issues. So it's been what now 7 years since the last time we comprehensively looked at the rule and proposed amendments. So I think we should. I got to get it in the queue.
Real briefly, we should have done this in the beginning, but I wanted to get it started so that we could contain our audience. I'd like to start on my far left and have each of our panelists give you a very brief introduction as to who they are, where they live, what they do. Jerry?
I'm Jerry Adler. I'm with the law firm of Guzab Officing in the city of New York. I live in the city of New York. I've been living there a long time. And my firm specializes in the area of corporate securities law, reverse mergers, acquisitions, and all of the above.
And a board member for me. Len?
I'm also a NIBA board member. My name is Lynn Boldup. I'm a partner with the law firm of Oswald & Yap out of Irvine, California. I represent both broker-dealers as well as micro-cap and small-cap issues in corporate securities work.
Mary?
I'm Mary O'Hara from the law firm of Madonna Griffiths O'Hara in Manhattan. We represent private companies and smaller public companies, as well as investors who invest in them.
Raul?
My name is Raul Rodriguez, and have a small firm in Denver, Colorado by the name of Rodriguez and Associates. And I do primarily corporate and securities work. And so I'm involved in representing a small issuer or sometimes a placement agent as well.
A man who needs no introduction, but go ahead and give one anyway.
Michael Shilley, ASG Securities. I'm also on the board, and we have this is your legislative and regulatory